Yes, sir. We are moving to the third question of the book back. I hope that you would have tried this question and this will give some value addition with regard to question number 3. ABC company's equity share is quoted in the market at 25 per share currently. That means MPS0 is equal to 25. Currently, one share is selling at 25, my dear lovable students. The company pays a dividend of 2 per share. So last year they paid 2 per share. And investor, market expect a growth rate of how much percent? So DPS 0 is equal to 2 per share and growth rate is equal to 6 percentage. So you tell me, you are required to calculate the company's cost of equity capital. Straightforward question. We have to just calculate the KE. Shall we calculate KE? KE is equal to DPS 1 divided by MPS 0 plus G. Sir, we all know that DPS 1 is equal to DPS 0 into 1 plus G. Because DPS 0 will not have the growth component. DPS 1 will have the growth component. So DPS 0 is 2 into 1.06 is the DPS 1. So 2 into 1.06 means 2.12 is the DPS 1. So we can finalize the KE. Basically KE is equal to, sir, 2.12 divided by MPS 0 already given in the question as 25 plus they are expecting a growth rate of 6 percentage. So 2.12 divided by 25 means 8.48 percentage plus 6 means 14.48 percentage is the KE, that is cost of the equity. That's what 14.48 percentage. Brilliant, sir. So what is the KE formula? KE is equal to DPS 1 divided by MPS 0 plus G. DPS 1 means expected dividend per share. That is the dividend what they are going to pay in the next year. In order to enjoy the DPS 1, you have to invest MPS 0 today. And you are expecting plus growth also because you don't want the same dividend. You want the dividend to grow. So 2 into 1.06 divided by 25 plus 0.06 comes to 14.48 percentage. We have done with the first part of our answer. We will be getting 2 mark. Another 2 mark or 4 mark. If the company issues 10% debenture of face value of 100 each. So the coupon rate is 10%, face value is equal to 100 and realizes 96 per debenture, that means 4 may be flotation cost. So 100 minus 4, company will be getting 96 rupees to enjoy. While the debenture are redeemable, you have to say 3 times. Redeemable. After how many years? At a premium of 12%. So we are not going to redeem at par. We are going to redeem at premium. Calculate the cost of debenture using YTM. YTM means yield to maturity, which is nothing but capital budgeting concept. Yield to maturity. Assume tax rate to be 50%. Sir, in order to find out the YTM approach, yield to maturity approach, my dear lovable students, I have to find out the IRR. I don't know at what rate discounted cash inflow will be equal to my discounted cash outflow. I don't know. I have to guess a rate through trial and error method. So basically, what is the concept of YTM, yield to maturity? Very simple. This concept is saying that the present value of any asset today, will be equal to the, sir, future value cash flow of that asset. For example, if I am paying 100 rupees and buying an asset today, what income, what cash flows that asset will generate, that is what yield to maturity. So present value of any asset today will be equal to the present value of its future cash flows. So if 2% value, if it is confusing, very simple, you can make the English like this, very simple. Value of an asset today value of a asset today is equal to present value of its future cash flows. Present value of its future cash flows. This is the idea or the logic behind the YTM. So, the value of an asset, that means today you are going to spend 96 rupees for a debenture. That is the value of the asset of the debenture. Should be equal to present value of its future cash flow. So what are the cash flows in future? Sir, you will be having two cash flows. One is annual cash flow and terminal cash flow. One is annual cash flow and other is, sir, what is the annual cash flow? Every year you will be getting interest net of tax. What is the percentage they are saying for the interest? 10% on the face value. So 100 into 10. So 100 face value into 10% comes to 10. But KD is equal to 1 into I into 1 minus T. That is 10 into 1 minus 0.5 because they said that assume 50% tax rate. So 5 rupees will be the cash inflow. And terminal cash flow at the end of the 12th year, sir, the company will pay a redemption value of 112 rupees. Are you comfortable? So as per YTM approach, yield to maturity, value of an asset today, today's value of the debenture is 96 rupees. This should be equal to the present value of its future cash flows. Future cash flow means you will get rupees 5. For how many years? 12 years. At some rate, only God knows what is the rate. That rate is only KD. Plus, you will be getting 112 on 12th year. Because on 12th year only redemption is happening. On 12th year. Are you all really with me? 12th year. At some rate, you have to discount. So, if you discount this cash flow with that rate, you should exactly get 96 rupees. Because at the IRR, discounted cash inflow will be equal to discounted cash. Only God knows at what rate this will be same. So generally what we will do, we will be doing, sir, at 10%. It is a global assumption that, not sir, Indian assumption, global assumption that present value will be at 10%. But instead of going like that, I am having a small technique. Sir, you find out the KD as per the approximation method. KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Right, sir? This is as per our approximation method. This answer should only form part of your working note. Just to guess that rate. That's it, man. Otherwise, you do 5%, 10%, 20%, 15%, half an hour swaha. Sir, I means interest. Interest means 10 into 1 minus 0.5 plus RV 112, 96 is the NP divided by 12 years whole divided by 112 plus 96 divided by 2 into 100. If we cut short this formula, sir, 10 into 1 minus 0.5 means 5 plus, sir, basically 112 minus 96, there is a capital loss of 16 rupees. The 16 capital loss has to be bared over a period of 12 years. So 1.33 per year is the capital cost divided by 112 plus 96 divided by 2 means average liability will be 104 into 100. Are you comfortable, sir? That means 5 plus 1.33 divided by, that is 6.33 divided by 104 into 100. So 6.33 divided by 104 into 100 means, sir, approximately 6.08% is the KD as per the approximation method. But they don't want as per the approximation method. They want as per the YTM. So what I will do, you know, I will be discounting my cash flow at 5%. I will be discounting my cash flow at, and I will be checking whether I am getting positive NPV or not. Alright, sir. So what I will be doing, I am going to discount my cash flows. So basically, this is like my year and this is my cash flow. Present value factor at 5% and I should get the discounted cash flow. Alright, sir. I am going to find out the discounted cash inflow. In from 1 to 12 years, I will be having 5 rupees as a dividend. I will be taking calculator, man. In calculator, 1 divided by 1.05. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, GT. What is the GT you are getting? Say 8, 8.86. That is at the discounting factor of 5%. For how many years? 12 years. So how you have to do? 1 divided by 1.05. You will be getting 0.99, 0.952. From there, you have to equal to for how many years? 12 years. GT, 8.86. Fine. So 8.86 into 5 comes to 44.3 is the discounted cash flow today. Now on 12th year, you will be getting 112 rupees. At a discounting factor of 5%, what is the present value factor for 12th year? 0.556. So 112 into 0.556 means 62.272. 0.556 no. 0.556 into 112. How much? 62.272. So 62.272 plus upper discounted cash inflow will be equal to 44.3 plus 62.272 comes to 106.572. But less discounted cash outflow is only 96. So you are getting positive NPV. So 106.572 minus 96 comes to 10.572 is the positive NPV. I don't want positive NPV. I want exactly equal. But I know that when I increase the rate from 5 to 6% or 7%, I will start falling the positive NPV and start getting the negative. So from 5, shall we jump to 7? Yes, sir. So I am putting 7, present value factor at 7. Why you know? Why I started 5? Because I know the answer is 6.08 in between. So I discounted 5. Now I am going for 7. Fantastic, sir. So here, cash flow, the next one, sir, present value factor at 7%, discounted cash flow. Year 1 to 12, you will be having cash inflow of 5 rupees. Right, sir? So 1 divided by 1.07 is equal to for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. GT will be 7.942. So you tell me 5 into 7.942 comes to 39.71. Are you getting it? Am I right with the calculation? On the 12th year, I will be getting 112. You tell me what is the present value factor at 7% for 12th year? 0.444. So 112 into 0.444 comes to 49.728. So technically my discounted cash inflow will be equal to 39.71 plus 49.728 comes to 89.438. Yes, sir. Less discounted cash outflow is 96. So 89.438 minus 96 comes to 6.562 negative NPV. So I understood that my IRR is between 5 to 7%. So IRR, calculation of IRR. We all know that this is how we used to calculate the IRR. At 7% and at 5%. At 7%, 6.562 negative. Because this is left hand side of the timeline is negative. I don't want negative. I want exactly NPV is equal to 0. And my dear lovable students, at 5% positive, 10.572. 10.572. Are you comfortable? Then I have to travel from this to this, but I have traveled from this to this. Right, sir? So I have totally traveled 6.562 plus 10.572. This is the total distance I have traveled. So 6.562 plus 10.572 means 17.134 has been traveled. So my IRR will be, sir, 6.562 divided by 17.134 into 2 miles totally I have traveled, because from 7 to 5 percentage. This everything the logic I have explained in the class. So 6.562 divided by 17.134 into 2 means 0.76659. Basically, can I take 6? So from the total here of how much percent? 7 percentage. If I am reducing 0.766, so 7 minus 0.766 comes to 6.234 percentage is the IRR. So KD is equal to 6.234 percentage. So that's what they have tried in the ICI. They find out that 6.45 percentage is the KD. For us, what is that? 6.234 percentage is the KD. The logic or the reason is, after they tried from 7, they have reached to 10. So they have kept a gap of 5 to 10 percentage. But we kept a gap of 5 to 7 percentage. Always if the distance is less, we will get more accurate answer. Our answer is only more correct than ICI. Are you really with me? So what they have done, my dear lovable students, cost of debenture KD using present value method. That's what YTM, yield to maturity. Identification of the relevant cash flow, year 0, current market price 96. That means as an investor, you just tell me today you have to go and invest 96. So that 96 will be cash inflow or cash outflow? Cash outflow. That's why they are taking 96 as cash outflow. Brilliant, beautiful concept, sir. 1 to 12 years, you will get interest net of tax. That is I into what minus T? 1 minus T. Which is 10 percentage of 100 comes to 10 into 1 minus T tax rate. So 5 rupees will be the cash. This is a future cash flow. So this is going to be the cash inflow. Redemption value is also a cash inflow. On 12th year, redemption value will be 112 rupees. Right, sir? So calculation of NPV at 2 discount rate. Question, I've never said that you have to take the gap between 5 and 10 percentage. So how this ICI got 5%? Sir, that is just a fluke. How they have to make the fluke, which is nothing but KD into 1 minus T plus RV minus NP divided by N. Whole divided by RV plus NP divided by 2 into 100. By using that formula, sir, we will reach somewhere nearing the answer. But that is only an approximation, not the right answer. So this is cash outflow. 1 to 12 years, 5 rupees is the cash inflow. This is a cumulative discounting factor, 8.863. At this 44.32, on 12th year you will be getting 112.557. So 10.7 positive NPV you are getting. Immediately they have jumped to 10 instead of jumping to 7. If they have jumped to 7, this negative would have been, sir, reduced. Like us, our negative is 6.562, their negative is 26.2. So there is a huge gap between 6 and 26 because we have jumped only to 7, they have jumped to 10. Right, sir? So IRR, by using the interpolation method, my dear lovable students, sir, IRR is equal to 6.45 percentage. So KD is equal to 6.45 percentage. Look at the answer, man. Third question, calculate the company's cost of equity capital. We have find out KE. And if the company issues 10% debenture of face value of 100 each and realizes 96 per debenture, while the debenture are redeemable after 12 years at a premium of 12%, calculate the cost of debenture using YTM, that is yield to maturity, which is nothing but IRR, which is nothing but capital budgeting. YTM is teaching us a concept that the value of an asset today is equal to present value of its future cash flows. Comfortable? I think without doubt, 1000% clarity will be there in the YTM. And you will be able to solve, I suppose. If that is the case, if you have gone wrong, read the question now. If that is the case, try this question, question number 4 by yourself, my dear lovable students. And to check the answer, sir, go through the answer format. I am waiting here for you trying question number 4. We'll meet in question number 4th video. With this, we can say that out of 7 questions, we have completed 3 questions of our book back.